Hello traders, this is John Kicklighter, Chief Strategist for DailyFX.com. It is Wednesday, February the 19th. We're here to talk about the FX market developments and, of course, the broader financial developments over the past 24 hours, as well as discuss what is likely ahead of us in the next 24 hours and beyond. Now, the opening 24 hours of this week, we knew were relatively restrained. That was a necessity of market conditions. Remember when the trifecta of market analysis breaks down into fundamentals, technicals, and market conditions. Knowing that the U.S. markets were offline for a market holiday, President's holiday, there was a disruption in risk-based themes, or those bigger transmutable fundamental themes. Well, markets were back on. The U.S. markets were back online this past session, Tuesday, and did we get a definitive roll from these bigger or underlying themes? It wouldn't seem so. However, I think in this relatively lax level of momentum, we still have a remarkable trend in consistency. So looking at the S&P 500 as a benchmark for risk-based trends, you can see that we've had an incredible drive, 9 consecutive trading days to the upside. Now, this is a move that we have only seen matched or beat in the past 5 years since we bottomed out back in the first quarter of 2009 twice. All right. This is a good reflection of the bearings that we have from the market and how we can drift in that direction without having full-blown confidence, without having full-blown commitment. All right. This is a very exposed and risky position to be in because it inherently suggests that while you do have this drift, it's more likely due to a lack of participation or a lack of desire to break from the general current than it is of conviction itself. Now that might seem fine to trade into, but you have to be very cautious because it suggests that when we come up to meaningful technical levels, like you can see the S&P 500 is here, it is going to struggle to make a break to the upside and generate, more importantly, follow-through. It also suggests that if there is going to be something that stirs the market, this lack of consistency or this lack of conviction exposes us much more to the move to the downside because the people that are building up this trend right now have driven this 9 consecutive day rally are going to be quick to bail out on this market. They're going to be quick to stop to take their short-term gains. All right? An exceptionally risky position to be in, but that is the reality of the markets that we face. Now, the S&P 500, this is CFD based. You can see 9 days is pretty impressive. But if you look at the E-minis, another derivative, and this is from the futures market, this has gone up for 11 consecutive trading days. 11 consecutive trading days. As you can see, this has only happened once before, back in the middle of 2010. So an incredible, incredible move. Now alone, I wouldn't be too active on just calling this an immediate risk of a top. We've seen consistent runs go for longer, and many different currency pairs, many different asset classes. We've seen the market stall once and then continue a break to the upside of prevailing resistance. But I put this big run into context with something like the 1850 range high. I put it into context with the general circumstances surrounding risk trends, where complacency has dropped to, once again, to remarkable levels. Here's the volatility measures across the board. All right, this is volatility measures for equities, FX, gold, treasuries, and emerging markets. All of them have significantly deflated. Now, this might seem a reassuring situation, but to me this is not. To me this reflects greater risk of something that can catalyze and imbalance this very dubious equilibrium. And if that is going to be the case, you have to always be more concerned about the break to the opposite side of the prevailing trend. Now, of course, probabilities which suggest that the break is more likely to be a move to the upside, and that's just naturally fits with this larger trend. However, follow-through is going to be troubled on the upside. One, because the fundamentals and the technicals do not align very nicely when we talk about risk-based trends. If you want to look at a purely quantitative assessment, we can always put it up to something like my risk-reward index, which is quite basically a measure of the rate of return in the markets, the developed world, so the rate of return 10-year yields on the majors, divided by the FX volatility index. And as you can see, we have clearly outpaced its performance. All right, we're kind of topping once again around the early 2011 swing high. We can also look at the relative performance of the various asset classes, where we can see that, yes, they have all appreciated from where they were at the bottom back in early March of 2009, but realistically speaking, they are on very different wavelengths. Furthermore, we look at the interest rate forecast, we look at the growth forecast, we look at the lingering risk to financial stability, and there's always something for us to be concerned about. So in terms of probability and lean and bias, yes, this has a bullish lean risk trends, but we should have a healthy dose of skepticism. Now, of course, if we get a break to the upside and we start to see the fundamental elements develop to support it, then it could be something that we or I trade into, but I need to see that fundamental conviction. Now, I'm going to be exceptionally tuned to potential risk aversion themes going forward, because there are more and more threats popping up on a near daily basis. The greatest concern, and one that we don't necessarily see covered too much, we've had over the past couple of weeks and months discussion about what the taper holds in store for the world, and of course we do think that I think the taper is of a very considerable concern, but its immediate influence on the dollar, as you can see, is starting to temper. This is the U.S. dollar versus the search traffic or interest in the taper story, and you can see it has bottomed out. It's actually the lowest we've had since really it began back in May of last year. The same circumstances for the S&P 500. As these taper concerns are fading, it's actually helping to support the S&P 500. All right, so it's pulling back on that risk premium that had previously weighed the risk-sensitive S&P 500 and helping to lift it a little bit. But the taper, just because it's lacking in popularity of immediate influence and media coverage, does not necessarily mean it won't have its actual outcome or impact on actual price action and yields. It will have its impact, and that is going to lead to greater concerns down the line. However, we can't just look at the S&P 500 and say it's going to immediately be impacted by taper, because that is, according to what we just saw, not necessarily a major market mover. We have to look where the market movers are. We have to see what can actually drive price action. Now, of greater concern, and one that has been hitting the wires, and it hasn't necessarily generated the kind of fear that we've seen in the past, but I do think that we have to be very, very concerned about it, is the situation in China. Now, we group China in emerging markets, generally, and you can see that the emerging markets have seen something of a bounce before they made a critical collapse to the downside, and this is actually the volatility index for the emerging markets flipped upside down. So the fear in this general grouping has diminished. However, China itself has more influence on general or broader risk-based trends than the cumulative influence of all the other emerging markets. All right, it is the world's second largest economy, and it definitely influences the ebb and flow of sentiment tides. That being said, we've seen over the past couple of days release of data that suggests that lending surged in January. All right, as did bad loans, their highest since September of 2008. We also, and from this, we suggest that there is a big influx of capital. They're trying to support the economy. But at the same time, we also learned that the People's Bank of China actually executed some reverse repos, 14-day repos. This is the first time they've done this. And this is a move to drain capital from the market, to kind of take the edge off of extreme credit market lending expansion. This is the first time they've done this in 8 months. All right, so we're getting very mixed signals. Why are they doing this? Well, it's because they have to fine-tune this. The situation has gotten to the point where they have to be proactive and active in what they're doing. So China definitely has a potential catalyst position in this market. You have to definitely be aware of what's happening during the Asia session and look for a risk-based move that begins in the Asia session. Now, ultimately, we never know what the ultimate catalyst for a risk-based move can be, and very oftentimes, when we see that trend develop, it's based upon momentum that often is sparked by the most mundane of releases or news or indicators, but it builds up like a butterfly effect because the market is sitting there waiting to actually act to its shift in risk trends. Right? So, the best thing we can do is watch the markets themselves. This is something that Jamie actually lives by, and it's a good thing to live by. So what we're going to be doing is watching various benchmarks for risk trends. The Asia session, which I'm currently in, is the Nikkei 225, my preferred index. You can see it actually rallied back up to 15,000, supported significantly by what the Bank of Japan did yesterday. We'll talk about that. But then we will move on to the European equity indexes, the DAX or the FTSE 100, and then of course we get back to the S&P 500. This looks like a big acceleration and it's leveling off. All right, two nice doji candles or small body candles. This is a very easy or very high probability reversal pattern. But first, and this is actually in today's strategy video, I talked about when to trade breakouts. This would be a breakout from the short-term congestion up here. You trade the breakout, and that also includes reversals, when you see confirmation. You don't try to preempt it, because when you try to preempt it, you're paying for it. All right? It's best to look to give up a little bit of return for a greater sense of certitude in that actual trade. All right? So big exposure to risk themes. We will watch all three of these benchmarks. Now, what am I keeping on my tab as a risk-sensitive currency opportunity? Dollar yen. I had a short until yesterday when I trailed my stop to break even. I had to because of the Bank of Japan rate decision. Good thing I did because it knocked me out of break even. I mean, it hasn't. I would not necessarily be very deep in the red at this moment if I still had it on, but it has warped the trading appeal of this. And this is much more to do with the yen itself, but we'll discuss this in context with the risk trend in just a second. But I also am keeping an eye on other risk-sensitive yen crosses. Aussie yen, as you can see, a rising trend into this more prominent descending trend line. All right, so medium term it's flat, short term it's bullish, long term it's flat. All right, this is a good, interesting currency pair. Remember those high, medium time frames. It helps you to assess what your scale, your time frame, and your bias would be for the time frame of trade that you're looking to take. But I'm looking for a breakout here. The same with the Kiwi yen. Very similar in circumstance, though longer term bullish. And medium term, I would say, a little bit more flat, but still has a bullish lean to it. So these pairs certainly have their risk exposure. I still think the euro-yen is most extraordinary for its risk lean. And if you want to put a second in there, it'd be the pound-yen. Both of these currency pairs have less to be optimistic about in terms of yield. These are going to be carry trades that will get slammed in risk aversion. So if there is a risk aversion move, I prefer these two, but the Kiwi yen, Aussie yen, certainly close seconds. We could even look at the dollar yen, but the dollar yen I don't think has as much appeal because of its confused safe haven status as well as confused carry interest. But the dollar yen is a very interesting argument to be made. It's a very illustrative currency pair because the dollar yen is something that highlights the Bank of Japan's monetary policy efforts versus what we see from the Fed. Now we know the Fed is engaged in taper. It looks like that's the status quo. This is what the Bank of Japan is doing, this blue line here. This is a very aggressive stimulus program. What we saw from the Bank of Japan stimulus update yesterday, they held QE. However, despite the fact that they held QE, the market read it as an expansion of QE. All right, they bolstered all of those yen crosses, including the dollar yen. Now, why would they do that? Well, there were a couple of changes that had to be made and were expected to be made. And that was a extension of 3 lending programs that were set and were due to expire next month. They had to roll it out another year to ensure that they're still functional, but that wasn't necessarily new stimulus. Furthermore, an expansion, a doubling of 2 of those particular programs were necessary to engage the QE that they've already put into place, the QE that they already vowed to use. Now, of the 21.5 trillion yen in those stimulus programs, the lending programs that they have earmarked, only 9 trillion has been used. All right? So just because they increase the size of the fire hose does not necessarily mean they're increasing the volume of water. And that's the QE. So when you see this rebound, be skeptical. When you see this rebound of euro yen, be skeptical. When we see the Aussie yen marching up to its meaningful trend line, be skeptical. All right? This is going to be very much a reflection of the more important fundamental themes, and this QE catalyst has essentially lost its potential. All right? And now it's on to the next QE program. Now it's on to speculating on what policy officials say and trying to discern whether they're going to upgrade QE going forward. That's the important aspect. That's the important part. So, unless we see something more definitive about more QE or not, this relationship comes back into play. This relationship is once again the most important thing to watch. Risk trends. Right? That's why we watch yen crosses for risk, because they are carry trades. Yet they are carry trades with very, very little in the way of meaningful return. Over the next 24 hours, risk trends are going to be, as they always are, a meaningful threat, but I think that our interest should lie in specific pieces of event risk, things that we know can move this market. I think that once again, the British pound presents itself as the most potential laden event risks. The pound dollar, as you can see, put in for a back-to-back decline. I haven't seen this in a while, but this pulls us off of that multi-year high. Also happens to be a longer-term fib, a 50% fib retracement of this July 2008 to January 2009 low, right there at around the 168. All right, so we've held that line. We're starting to retrace. This is fitting of what the fundamental considerations are. The Bank of England's interest rate expectations have driven it to the heights that it has gotten to. However, those interest rate expectations, the Bank of England itself has attempted to consistently try to talk down. All right? And while we can doubt them as much as we want, at some point we start to track to reality. So the forecast that the Bank of England offers, and suggesting that they're not going to move until 2015, is going to start aligning to market expectations. Those market expectations more likely to adjust to what the central bank says. So there's a good probability that the pound is going to continue to pull back. This is especially true if data supports a softer interest rate forecast. All right. So when we look at something like this past session's CPI figures, we have something to be concerned about. We have something to be concerned about if you're a pound bull. The CPI figures, once again, this is my manic crisis calendar, so I color it. It's color coordinated according to how it influences risk trends. The CPI figure was 1.9%. That's the first time it was below the Bank of England's 2% target since November of 2008. Long time for that. But what it does importantly from a monetary policy perspective, it takes away the need for the Bank of England to act. All right? They don't have to hike rates because inflation is not a problem. All right? So that takes the immediate concern off the table. Now, if you want to further see this expectation for a rate hike diminish, a rate hike for 2014 or late 2014, and push it back to 2015, we'll see if there's going to be data that follows it up. The Bank of England minutes are going to be something of a rehash of what we had from the quarterly inflation report. I'm not expecting much from that. But the unemployment rate is definitely going to tap into something more important to the Bank of England. This has been trending down towards a 7% target very, very quickly. They're at 7.1%. We'll see what happens at this update. But if this happens to stall, that was the pressure that people were most expecting to force the Bank of England's hand. All right? The risks are far more weighted to the downside, in other words, for the pound. So keep this in mind. This is going to be an interesting one. It doesn't have to necessarily just be the pound dollar, although given that both the Fed and the Bank of England are going about discussing the possibility of interest rate hikes in the future, this imbalance that we have in price compared to fundamentals is perhaps the most extreme. So I'm going to be watching this one with considerable intent. Potentially, if it gets below this 166.50 level, that can be an interesting entry point for a short. Of course, it has to happen on fundamental encouragement. Euro pound is another one that can play through. The euro pound has had this rebound off the bottom of this descending wedge pattern. Not necessarily my favorite trade because you have to have a reason to buy the euro, and I don't like that. It might be a better pound short setup. Pound Kiwi, trading within this range, a good range setup and good technical bearings, not necessarily the most exposed or extreme positioning. Pound Aussie, much better. You can see in a short-term basis, chop, very nasty chop. You can get a short-term breakout either to the upside or the downside, offers a very interesting short-term play. But if we can get something more convincing to the upside, it would continue a run that we've gone on for a number of months now, for a very long time, nearly a full year. But realistically, if we can break this head and shoulders pattern, and this completes the right shoulder, that could be a very, very interesting play. Much like the pound dollar, the Aussie interest rate forecast is severely underappreciated. If this gives it a reason to be more balanced, this upcoming UK data, we have something very interesting on our hands. Now, it's not just about the UK data, although that's going to be most market moving. Keep an eye on other catalysts. The US dollar has been interesting, especially after this past session's tick flows. We have some housing data and some Fed speakers, including the minutes in the upcoming session. But most of my interest from the dollar's fundamental perspective is going to be tied up into risk trends, at least until we get to Thursday's CPI figures. All right, a lot of opportunity out there, and it doesn't have to be just fundamentally derived. It doesn't have to be big risk-based themes. You can also look for short-term technical plays like the dollar CAD's immediate breakout risk, as well as the Aussie dollar short-term breakout risk out there. There's a lot of opportunity from a technical and a fundamental basis, but make sure that your strategy fits what your analysis says. All right, very important. All right, I'll update you on these markets once again tomorrow. In the meantime, good luck trading out there.